Welcome, everyone. My name is Chris Brummer. I'm a law professor over at Georgetown University Law Center and also a senior fellow over at the Milken Institute. It's great to see you today. We're going to have a very interesting, very dynamic panel on financial inclusion. Financial inclusion and its impact on economic growth, how it's been enabled by new kinds of technology, is of immense importance. It's of importance given the changing demographics that we see in the world, the new kinds of opportunities that are presenting themselves with lowered barriers to entry for new kinds of market participants and new kinds of services for those who have traditionally been locked out of access to capital for building businesses, building homes, and building lives. And I'm very, very, very excited and pleased to have some of the leading thinkers and some of the leading actors who are involved in participating in this space. It can get a little bit weedy, even for the nerdy law professor. And after I very quickly introduce our panelists, the format will be really sort of walking us through some concrete examples of how market participants are helping to enable a little bit more financial inclusion, and then we'll get into a conversation, both with the panelists and also for those of you who may have some questions here. But briefly, a very quick introduction. I have to my immediate right Chris Larson, who is the CEO of Ripple Labs. It's a little bit going backwards and forth with the lineup here, but with Bill Berheit, who is the CEO of Abra. Shamina Singh, to my immediate left, is the executive director of the MasterCard Center of Inclusion and Growth, and then David Thompson is the CIO of Western Union. For those of you who have noticed a bit of a pattern between these people, they are individuals who are actively engaged in building the kind of financial infrastructure, the kinds of systems and payment systems and credit systems that are working to broaden the range of opportunities and access to capital and finance, both in the United States and abroad. Okay, with that, however, let's get a little bit into a concrete conversation. And I think Bob is really one of the best persons to begin this conversation as a pioneer of M-Pesa. Bob, maybe if you could give us, first from a large sort of 10,000-foot level, your vision, your understanding of the term financial inclusion, because there's a little bit of, if not a debate, at least differences of opinion as to what it really is. And then if you could maybe give us an example of how SAFRICOM is working to promote financial inclusion and what kinds of opportunities that growth has on economic growth, particularly in Africa.
So there's a real worrying moment there, because we prepared for this, and I really hoped that he was going to ask me the right question, and he did. He could have asked me anything. So I mean, let's try and put this whole thing in context. What is financial exclusion? The World Bank reckons that half the world's population, or 2.5 billion adults, are unbanked. And what does that then mean for the unbanked? Usually they're low-income people who have an irregular income and then have an irregular spending needs. And if you don't have access to formal financial structures, it becomes difficult. Firstly, if you need to borrow money, the interest rates tend to be usurious. Now, in Kenya, you could be paying 100% for a small loan. You're then not able to mobilize savings. In order to save in a bank, you need to first of all get to the bank. The bank may be several tens of kilometers away. You don't have access to transport, and if you do, it becomes very expensive. It's very difficult for governments at the macro level, very difficult for governments to actually see what's the kind of money which is circulating in the economy, because much of that is done in the informal sector. It's therefore very difficult for them to make informed policy decisions. So for us and there's also some issues around access to education, access to healthcare. In Kenya, for example, and large parts of Africa, much of that stuff is emergency funding. So when you're sick, you desperately have to try and raise cash because you weren't able to save, you weren't able to take an insurance policy, that kind of thing. In Kenya, we have an insurance rate of less than 4%, between 3 and 4% of people have insurance, and that's all insurance. It's not just health insurance. And that creates all sorts of challenges. So a little while back, we invented a thing called M-Pesa. And M-Pesa is probably the main reason why I'm sitting on the stage. And M-Pesa was designed to help people to move money from one person to the next. And there's a lot of confusion over mobile banking and mobile money. And often, I was in a session yesterday where people were talking about, about banks objecting to this thing because it's mobile banking. There's a difference between them. Mobile money is mobile payment. It's being able to, it substitutes cash. It moves value from one person to the next. Now, having done that, we've now evolved this thing to do more and to really start to get into financial inclusion. So we introduced mobile banking. So now you can save and you can borrow. And because of the structure of this, and I'm going to assume that many of you know what we're talking about here, but because of the structure, the cost structure means it's a lot cheaper than bricks and mortar. So clicks have effectively replaced bricks, which means that it's now possible to save 1 cent. And there's no system in the world that will allow you to save a cent. You have to take the cent to the bank has to deal with it, and you can borrow from as little as $1. You can do that because the cost structure is so much lower. We then moved into insurance, so you can now do micro-insurance, and you can pay premiums in increments of kind of like 10 cents a time. So you can see how the thing has evolved. I'm not going to, we'll kind of get into a bit more detail. But for us, it was trying to address this issue of the unbanked, the challenges of the unbanked. We developed something which was designed to move money from one place to the next and to substitute for cash, and that has now moved into kind of deeper financial inclusion and more meaningful financial inclusion.
Oh, that's wonderful, and it's really a great observation to ask yourself, are we talking about cash and a means of or an instrument for making payments, or are we looking at a payment system? Where does the line, where exactly is the line drawn, and really what does this mean from the standpoint of the kinds of opportunities you can create? Obviously, if you get one or two of the steps right, then maybe you can branch out into more complicated financial products like insurance and the like. But Bill, certainly you've been sorry, I was like, amazing, that's not Bill. I have my opposite man, Bill. You've been at the forefront of trying to understand and think through what those payment systems would mean, how to re-engineer payment systems and ideas in ways that cash itself could be facilitated not only through very simple financial infrastructure, but through phones themselves, and to almost leap step or leap jump this whole question of cryptocurrencies altogether by just creating and leveraging existing currencies. But maybe you could speak a little bit about.
He told us not to use words like cryptocurrency. Remember on the briefing call? Now he's using cryptocurrencies.
Oh, no. I said you have to explain it, and that's where I broke my rule, which is to explain, there are different kinds of things you can use. You can use cash. You can make up a certain kind of currency. Those currencies can be currencies that you can use and can easily identify who holds the currency, who uses the currency. And then you can have more traditional kinds of currencies, dollars, euros, and yen. And then obviously you can get to different kinds of systems by which one actually uses those currencies for payment. But I think it's a sly smile that you have on your face. I was wondering if you could maybe explain a bit about your business and how it works.
Sure. So I was asked to kind of prepare like 3-4 minutes of an introduction because what we're doing is so radically different. that just me talking probably wouldn't necessarily get the point across. So I've prepared, is this on? Maybe not. So can you skip to the Abra piece of the deck? So I want you to, I had this idea probably about 15 years ago, and the idea was, why couldn't I take the growing proliferation of phones that were doing text messaging and be able to text money effectively between any two phones in the world? And about a year ago, when I was talking about what I was going to do next with one of my original investors in Boom Financial, I said to him, I said, it's 2014, and now with the proliferation of smartphones, and you just told me that you guys don't even sell feature phones anymore, you only sell smartphones in Kenya, okay? You still can't send money between any two phone numbers in the world in 2015. That is unbelievable to me, right? So I said, I really think that all of the pieces are finally in place to be able to move money between any two phone numbers in the world. And notice I didn't say banks, I didn't say people, I explicitly said phone numbers, because it's for the first time we live in a hyper-connected world where the hyperconnection is based upon cellular connectivity. But when I thought about it more, I realized that the only way to do that was, especially given what you have to go through to manage that one penny in a savings model, the only way to do that was if you could store the money directly on the phone itself. Not in a bank account, not in a stored value somewhere, not in a debit card, but directly on the phone. Because what are you trying to do if I say, can I send money to your phone right now? Well, I'm trying to create a replacement for taking $20 out of my pocket and handing it to you, because there's probably a desert or an ocean or a few cities in between us. So my belief a year ago was that all of the pieces might be in place, not 100% certain, but might be in place to actually do that for the first time. Well, can you go to the next slide? And the next one? So it turns out that all the pieces are in place to be able to do that. So myself and about 10 other venture firms and 10 other people created a new company called Abra, or what we affectionately call Abra, which is a better remittance app. The idea of Abra is exactly what I said. For the first time, you can now move money between any two phone numbers in the world. How do we do that? There's three things, three huge problems that we had to solve to make this work. Okay? The first problem is, how can you store fiat money, real money, on a phone? It doesn't really seem logical. There's no slot to stick cash into a smartphone. We have solved that problem, okay? Using sophisticated financial engineering and some modern cryptocurrency techniques, even though I'm not allowed to use the word, we can now store real cash on a phone. More importantly, we can do it in a way that is completely consumer friendly. Two, I can now move that money peer-to-peer between any two phones in the world, as long as they're both smartphones. And thank you for solving that problem. Okay? So, right, so if you're with me, I can now store digital cash, ones and zeros, on a phone. I can now move that digital cash between any two smartphones in the world. But wait a minute, okay, that gets me part of the way, but most people on the planet still rely on paper money. So how can I build a system where I can get access to cash, whether I'm in I just came back from the Philippines, in a rural village in Mindanao, or in the middle of Makati in Manila. And M-Pesa also gives you a clue to this, but where there is no global carrier that can ask or force, or whatever the right word is, airtime agents to become mobile money agents, there's only one answer. And that is to turn every single smartphone in the world into an ATM machine for everyone else. That's what we've done. So we've designed a system that does all three of those things. It allows anybody to act as an ATM machine for anyone else by simply meeting, and you use a QR code to validate who the other person is. You hand them cash, they push digital currency to your phone, and you instantly have digital cash in your phone. You can send that money to any phone number in the world. That person on that remote island in Mindanao, or in the village in Mindanao, can now use their smartphone, find somebody locally in their village, withdraw the funds through one of these, we call them tellers, in their village.
Can I just ask really briefly, was this viewed as a solution to a problem of the unbanked, or is this also viewed as something that's portable to other parts, to more advanced economies?
The unbanked don't perceive their problem as them being unbanked. Okay, I've yet to meet anybody who's a cash consumer who claims that their problem is that they're unbanked. Okay, that's nonsense. I would actually claim that 99.999% of people who are unbanked don't understand what the two words financial inclusion together actually mean. Or at least having built foundations in Haiti, built agent networks in Mexico, worked in Southeast Asia, I have yet to meet anybody who understands those two words in the context where we theoretically mean them. Okay, so put that aside. To your point, they're trying to move money from point A to point B and have access either to supporting their family as a result or have access to commerce that they may not have access to as a result of not being able to move money to point A to point B. That's it.
Great.
Right? And can I do it better, faster, and cheaper than all of my alternatives today? That's it.
Yeah, he's solving a problem which is not just an unbanked problem. Because with M-Pesa, we started with the so-called unbanked, but now I use M-Pesa more than anyone else. Because the problem he's solving is not an unbanked problem. It's a problem
it's
how
a cash
do you
problem.
move money from here to there.
So ultimately, the answer to your question was, if you want to give people access using hyper-connected networks to moving money around and access to commerce, don't get rid of cash. Make a better cash.
Interesting.
That's what we did.
Chris, is that the answer? Make a better cash?
Well, obviously there's a lot of discussion around cryptocurrency, and I think that started off with, okay, build a new currency that the whole world would adopt. We think pretty clearly that original notion has moved to the idea that no, the real big thing around cryptocurrency is more kind of global rails, and we would kind of call that the beginning of the Internet of value. And I think we also have some slides up here. Maybe we can get to the Ripple slides, but so we're trying to approach it maybe a little bit differently. We think there's a couple of different technological revolutions happening at the same time. Ripple is actually focused on being a protocol to connect financial networks and local banks. It's obviously a distributed ledger technology. We do think it does play a role in solving, the underbanked issue, connecting the 2 billion people that are underbanked, but in an indirect way, by sort of making available kind of a bigger variety of local banks and financial providers that might exist anywhere. If we can go to the next slide. So obviously we do believe, this notion of solving the last mile is incredibly important. We think there's obviously a ton of progress being made by everybody else on this panel, and 90% of the world is covered by cell phone networks. Just about everybody has a feature phone where you can do all the amazing things that are being done by others on this panel. That's not the problem we're working on. So we're trying to solve the problem of connecting local banks and financial institutions to the global economy, not local people to local banks. So that's kind of visualized here. We have this problem where we have just a variety of different networks, whether it be in the U.S. or Kenya or Europe, that are not connected. So that's a problem. To Bill's point, you can make a phone call to anybody with a phone number. You can send an email to anybody with an email address. You can only pay people really who are in your payment network. So the goal is how do you get all these things operating together. And we would kind of point out that this problem is actually getting worse. We'll go to the next slide. And we can see the headlines every day. Banks are pulling back just because of the amazing amount of risk and sort of attention that's being rightfully so, of course, on anti-money laundering, tax evasion, terrorism, financing. But I mean, the cost for banks are skyrocketing, and that is resulting in banks actually pulling back. So global international banks are pulling out of local markets. Local banks are pulling out of correspondent banking networks, and so that's actually making this problem of interoperability worse, not better. So again, kind of advancing one more slide there, please. The idea here is, can you wire all these networks together with a free global infrastructure that would operate in any currency with any of these payment networks. That's really the goal. We can do that now. And the workaround before not having these things connected has been really around correspondent banking, which works, but is a pretty antiquated system that is very slow. That's why it takes sometimes 2+ days to move value across the world. It's very expensive for network operators, local banks, which directly impacts individuals, creates lots of barriers, and again, those networks are shrinking, they're not growing. So we think this distributed ledger technology is sort of coming around at the right time, and will be really important for helping the underbanked. If you think about the underbanked, I mean, the mobile revolution is tremendously powerful, but unless you sort of have the ability for networks globally to compete locally, local unbanked customers can get trapped in actually very hard to use, sort of expensive, unreliable networks. We see that happening all the time. So the ability to sort of have everybody working together, this internet of value, can be very, very helpful for people locally and globally. So, and stepping way back, we think there's 2 revolutions happening. One is clearly mobility. Cell phones are ubiquitous. Everybody has them. That's phenomenal. Everybody here is working on that, except for us. But at the same time, there's tremendous opportunity at the infrastructure layer. And when those 2 things start working together, I think that's really powerful for the underbanked. And kind of related to that, kind of these 2 things kind of happening in concert. I'm actually kind of excited to announce something for the first time that we are working on a pilot with Western Union to use Ripple, the Ripple technology for real-time settlement. And again, we love that idea of sort of last mile coming together with kind of distributed internet of value infrastructure. So again, thank you, David, for working with us. And so
you're seeing this revolution in technology and a revolution in infrastructure, where you're not necessarily seeing a lot of revolution is with some of the rules and regulations to sort of capture and channel a lot of these opportunities, because it's quite fascinating. On the one hand, when you're talking about a real-time gross settlement or a real-time settlement system, if you're talking about a way in which cash can be almost immediately transferred from one part of the world to another, that really does speak to a certain kind of risk that you've traditionally had with the banks, where in a very large or extended correspondent bank network, you can have a failure one place and it has ripple effects that undermine the financial stability. But here you're talking about a positive ripple, a technological ripple, to sort of make sure that those settlements and financial transactions are consummated as quickly as possible. But we'll definitely get back to questions of what other kinds of questions need to be answered from money laundering and the other kinds of concerns as these technologies proliferate. I know that Shamina Singh, the executive director again for MasterCard Center for Inclusive Growth, has been looking at not just these particular developments, but really a range of developments across the world, really. And I would be very interested, and I think we'd all like to hear sort of what your perspective is about where these technologies are headed. Where do you see particularly useful areas and sources of possibility, even as you possibly get out of your traditional banking systems and into more creative networks and arrangements between financial institutions?
Thanks for having me here. And how are y'all doing? We're supposed to be talking about financial inclusion. Do you know what financial inclusion is yet? Has anybody? Okay. So here's the deal. So right now, half of the world's adult population, as I said before, is not included in any form of financial system. What does that mean? They have no access to transactions. So for anybody who got here today using the internet, bought your airline ticket, paid for your hotel, maybe accessed an ATM, for half the world's adult population, that's not a reality. So imagine yourself living in that kind of reality and trying to transact. There's this really interesting notion that poor people have really simple financial lives, when it's actually the opposite is true. Time is their currency. They're trying to balance everything they have to do, whether it's farming, whether it's a side business, whether it's transportation, whether it's shopping, whether it's getting water, with their kids and everything else. So we talk a lot in the developed economies about balancing work and family and things like that, which is really great and interesting. But in developing economies and emerging markets for these populations, it's a reality that I don't think any of us can even fathom. So I think there's a little bit of just take a step and think about the person we're talking about here. We're talking about a worker who moves from India to Dubai to build the buildings in Dubai. He has to send money home to his family, who he often doesn't see for many years on end, and he can't do that because he lives in a cash economy for the most part. And so what we're talking about here is developing technology and developing ways where this worker can send money home to his family, and then they can take that money and actually use it in a way that they haven't been able to before. So there's also this piece about once you get the money, you have to be able to purchase goods and services. To an earlier person's point, people aren't thinking about being financially included or excluded. All they're thinking about is how they buy and sell goods, how they purchase, how they transact, how they go to the movies, how they do anything. So this is not about whether or not somebody's included or not included. It's about how are we working with the lowest 40% of the population to make sure that as responsible corporations, frankly, and as responsible private sector citizens, we're fulfilling our responsibility to make sure that we're not creating the internet of everything without the inclusion of everyone. And so I'll sort of say this very quickly. My prediction for this conference going forward is next year, this room will be triple its size. And then next year after that, we'll be on the same stage that Robert Rubin and others were on, because this population, it's half of the world's adult population. 2 billion with zero access. So you heard the number before, 2.5 billion. The new numbers just came out, and the good news is it's actually 2 billion who have zero access. Over 5 billion have limited access. So the purchasing power of this population, at least 4 trillion. By 2020, they think it'll double to 8 trillion. So this is a population that, yes, we are doing well while we do good, but it is a population that is rapidly becoming the consumers that all of us are trying to engage with. So this notion of financial inclusion, I think, is one that's very interesting. And the other thing I'll say is that technology is absolutely important. But I'll tell you, it's a tech game, it's an information play, and it's a partnership play. So those three things together are the critical pieces that have to come together in order for this thing to work, right? So you've heard a little bit about the technology, the information. So just a word about MasterCard, the MasterCard Center. So the reason why it's important that companies like MasterCard, Western Union, other folks are involved in this conversation and really do see it as a corporate business objective beyond a philanthropic perspective is that once you start leveraging a corporation's technology, resources, platform to focus on this particular population, you start to seeing amazing transformations. So the lessons that we're learning, so things like the fact that we have over 500 public-private partnership government programs right now in the world digitizing social subsidy programs for over 150 million people is teaching us a lot about how to serve this population and how to work this population. Why are we focused on social subsidies? Because if you think about the transactions that go in, the most stable source of income for a poor person is usually a government subsidy. And so if you want to intervene at the place where you know you're going to have the biggest impact, you intervene at the place where they get their government subsidy. Because every month or every week, usually cash trucks drive out to a village from the government with cash. People wait 4 days to get their social subsidy because they have to line up for the cash. Sometimes the cash trucks run out of money. So there they are sitting for 4 days without any cash. And so unless you start to think about, okay, if we could digitize, if we could make this transaction simpler, easier, safer, more secure, what would that happen to the entire supply chain for these individuals? And you talked about it before. The first thing that goes is corruption. So drug cartels don't operate in credit cards or digital transaction. They operate in cash, right? And so cash is an essential component of the economy. But when you're thinking about populations and transformation, think about the cost of cash and what that really means, especially to a woman who's trying to save with money under her mattress, who every month her husband or her son or anybody else comes and literally takes that cash. We're working with a group that a friend of mine is here called her name is Chetna Sinha, and she runs something called the Mandeshi Bank in India. And basically, since 2000, this community in rural Maharashtra has been using digital payments since 2000 in a place where you don't have connectivity, where you have online, offline, and things like that. So it's a really interesting time. So they're solving real problems for real people. And I'll just close by saying a little bit about what that means in terms of scale, because I think it's important to say that the partnership has to be with government, and it has to be with NGOs, and it has to be with the public sector. It has to be a good partnership between public and private. Nobody can do this alone. It has to have MNOs. It has to have all of us in this conversation. But what does it mean for us? It means that we have literally 95 billion anonymized real transactions that we can look at and examine the data to say what is working, what isn't working, what are the lives of the population, and how do we leverage it? When you're transacting 5.4 million transactions per hour in 210 countries, you get an awful lot of information.
Yeah, I want to pick that up. I want to pick that up because the kind of information that you get, on the one hand, can be raw data, useful data, big data for both financial authorities, for monetary authorities, for market participants, all of them to be able to use. However, obviously, that when it is anonymous or where the users of certain kinds of financial instruments use pseudonyms and cannot be easily identified, it does seem like you may be pushing back on corruption on one end, but obviously one of the regulatory concerns is, well, is that enabling other kinds of challenges, particularly when you get to money laundering, narco trafficking, and
let me just because I think for this population, I think we should be really clear about who we're talking about. I can't buy or sell unless nobody can buy or sell unless you have an identity with anybody. So when you're talking about money laundering and things like that, it's an issue, I think, between bank to bank and government to government. But for this population, I think they have to have an identity. In order to transact, you have to be able to do some sort of tiered level of KYC or know your customer. If you don't have an identity, and that's the other reality, a lot of these people do not have identity. There's nothing that says, I'm Shamina Singh when I'm born. So that's the population we're dealing with. And so I think it's really important that we talk about identity as a tool in order to engage in the formal economy. And so that's the piece I just want to make sure.
David, you've been so patient, and I particularly through these different conversations. But I think that you're really perhaps with Western Union in perhaps the best position to really think about the different kinds of populations we're all trying to grapple with. Just to push back a little bit, there are certain kinds of questions that are already arising as to whether or not we are pre-identifying a certain subset or certain kinds of population, and we're asking ourselves, what are the needs of these individuals? And let's try to find a term to capture what those needs are. And we're realizing that they don't have access to basic financial services, that they don't have access to banks or certain kinds of financial instruments, or we look at certain kinds of risks that arise or the exclusion that arises where even medium-sized financial institutions are not connected to the global economy, and that can also impact growth. I mean, what do you see in your work as you build a different, as you continue, I guess, Western Union's leadership in building a kind of global payment infrastructure? Who do you see yourself servicing? And what do you view as the future of sort of the global payments infrastructure?
So at Western Union, our whole company strategy is really focused on the underserved or unbanked. It's a company strategy that allows us to create a service or offer a service based on the needs of the consumers at the last mile, moving money globally. And it really allows us to move money for better. Most payments that go through the remittance systems around the globe are for family support. That worker you mentioned in Dubai is sending money back home on a weekly basis, and that they're waiting for that money to buy food, pay for their fertilizer on their farm, and really live. And what we find at Western Union is these populations are changing and they're moving. And so we are trying to create products that enable them. As the economies continue to evolve, we're finding that mobile is becoming a bigger component. Smartphones in very rural areas are starting to have some inroads. But really, what we're finding, though, is the ecosystem is not there to really use the capability in many of these locations. Many of these locations don't have power. They don't have water. And so to buy that fertilizer, the bag of fertilizer, you need cash. In most transactions, over 85% of remittances are done in cash around the globe. And so cash is still an important component, but we've built a service that offers cash, account to account, card to card, all various payment types around the globe. The biggest thing that I learned I joined Western Union from the technology industry, and what I found is I came with all these ideas of innovation. And the thing that I found is innovation is really hard in some of these locations, really, really hard. The UN deals with this all the time. And what I'm finding is the hard thing is regulations, you commented about this, regulations and the laws around the world don't make it easy to transact as someone who doesn't have an identity or someone who wants to send money to their family. It's very hard to do that. So we're creating processes that are focused on our consumers' needs, but also including them. I'll give you a great example. In the Philippines, there is a remittance rule that requires KYC over a certain amount, and KYC is Know Your Customer. So our agents have to know that individual, look at their ID. Well, these people don't have IDs, so they can't even be a part of the system. So we've worked with lawmakers to allow us to take their fingerprint or their photo. In that village, there's only 18 people. Our agent knows every one of them personally. And so the regulators are starting to see that by changing the laws, it allows these folks to be a part of an ecosystem. And so really working with these economies and regulators to build a system and enable these folks to send remittances. To give you an example, another example I think is very interesting, there's a concept in money transfer where you have limits to the amount of money you can send globally. Spain, for example, over $1,000, you have to do 2 IDs, you have to do a lot of KYC in an individual in Spain to send money. And then in other countries, there's no limits. And so in a global economy, there's so many different rules and laws. The technology can help, but you really have to understand the law in every country and make that work. And so that's what we do day in, day out is compliance globally. 170 different currencies around the globe. We operate in over 200 countries and territories around the globe. We move about $85 billion in principal on an annual basis, and that's larger than the GDP of 125 countries combined. And so this is an interesting business. There's a lot of room for innovation, but it is really hard work.
Yeah, you're raising a question that I think I want to also share with some of the other panelists, which is when you're talking about a global payments, there's a reason why payment systems have rules, right? You want to make sure to the extent possible that cash and value moves smoothly. You want to make sure that there are as few disruptions to your financial system because, as we've learned the hard way, those disruptions can undermine and drag down your country's GDP for a decade. And there's this sense that you need to make sure that your systems are robust enough so that different actors in a particular ecosystem, no matter where they are, can sort of interact with one another. But at the same time, you have this tremendous potential. I like to think, how, with Ripple, like how do you navigate that different regulatory terrain with Ripple, and then secondly, Bob, which I've got to ask, as a certain system becomes larger and more important to a country, that just naturally attracts a little bit more attention. Because people want to know what you're doing, what you plan to do as you start to become a conduit for a lot of financial transactions. When you build that infrastructure, how do you engage different, I guess it's a little bit easier when you have an infrastructure that's really committed to a certain region. But obviously, as you have a larger footprint, or how do you plan on that particular expansion? But I'll just start.
Sure. So one thing that's very good about distributed ledger technology is that everything is transparent. So you can see exactly anybody can see what's going through the ledger. And so you combine that with where we think this technology belongs, which is connecting payment systems. You sort of maintain all of the KYC, know your customer, anti-money laundering tools and processes of each provider. So that doesn't change. I mean, this notion that these things are going to replace all the providers, all the banks, and sort of individuals are just trading value anonymously with each other, that's not the way we believe this plays out. Far from it. Again, we think this technology is kind of, again, at the bottom of the stack, connects all the various payment networks, all the existing compliance stays in place, and then actually you pick up quite a bit of benefit from having point-to-point instant real-time transfers. So if you look at the way correspondent banking works today, if you were going to link together two networks, that actually can be very hard for anti-money laundering people to trace how value moves. It's going to literally take months to see what happened to a transaction. You go to this bank, then go to this bank. With these real-time distributed ledgering systems, again, think of Internet of Value, things moving in real time, you get end-to-end traceability. Everything's atomic. So you can kind of see exactly who the counterparties were, degrees of separation reporting. So that's just better for catching the bad guys. So I think that a lot of technology change, gets scary for regulators. But in fact, if you actually look what's going on broadly with these two big trends, it's actually quite a bit of good news for regulators. And if you're working with the right providers, they're the ones that would protect consumer privacy. So you can get that privacy and transparency working together. But it's going to be an education process, I think, as these new technologies roll out.
Great. And Bob, as
Yeah, I'd say the regulators are the biggest problem. I feel comfortable to say that because I think we have some pretty good regulators in Kenya. So I'm hidden behind a protective screen here. But whenever people say to me, why has a similar system not worked in any other countries? Plain and simple, the regulator, because the regulator fails to understand what Chris has just said, and that is technology gives you much more transparency. The alternative is cash, right? And I think Shamina said just now that for a drug dealer, for a child trafficker, all those guys, they would much rather deal with cash than to deal with the system. And what we found is that most countries are over-regulated because they're scared of the technology. But the technology gives you the transparency. Now, in our case, our regulator figured out that deepening financial inclusion made sense. It gave him much more visibility of what was happening in the economy. And to your concern a moment ago about the anonymity of it, you can't do it anonymously because you need a mobile phone. And if you have a mobile phone, I know who you are. I know where you are. I know lots of things about you. Whereas if you've got the cash in a briefcase, it isn't. The other problem we've got with the regulators is that they have been subjected to heavy lobbying by the banking industry, because the banking industry in many parts of the world has failed, and I pick on Nigeria. Again, I pick on Nigeria because I don't operate in Nigeria, so I'm not scared. But you pick on Nigeria, and people say, surely this thing can work in Nigeria. Well, of course it can. The problem is the banking industry have a very strong lobby and have lobbied effectively to stop this. And this is because, as I said at the beginning, people mistake the difference between mobile money and mobile banking.
Interesting. We'll open this up to the audience briefly, but I did want to at least end with one question, and this is, I guess, getting back also to Shamina's point, but I'm sure Bill may have an idea about this as well. We've identified we are talking largely, this conversation has been about people in developing countries, and I'm going to sort of bring it back. We've had some tough events here in the United States over the last 24 hours where you ask yourself about financial inclusion here, and you ask yourself, well, we have people in this country who don't always, if they don't have access to capital, in my hometown of Washington, D.C., you can go to a major retailer and you will see plenty of people using only cash. And they're only using cash because they don't have necessarily the same access to the kinds of banking systems and services that we take for granted. And this is here in our nation's capital. To what extent, can we, is this concept of we're always talking about the technology that we have here and how can we export it abroad. But, to what extent can these innovations, can these technological ideas be perhaps imported here and used for, if not unbanked, the severely underbanked here in the United States? And I guess I'll start with Shamina, since we had our original conversation about financial inclusion, and then to Bill.
Sure. I think actually the really cool stuff is happening outside of the United States. So I like to think of it as high tech, high touch, low tech in some respects. So you think about M-Pesa, you think about South Africa, you think about, in South Africa, we worked with a company when the government decided to go digital on their social benefits. We worked with a company to develop a technology that could be used offline, online, and literally produce biometric with thumbprint and voice recognition with or without connectivity, and produce your identification card in 8 minutes. They registered, this is what I'm talking about, this is the cool stuff that's happening outside of this country. They registered 22 million South Africans in under 1 year and cut the roll of corruption from 22 million recipients to 10 million cards. So right now in South Africa, the South African Social Security Agency has issued 10 million MasterCards covering 22 million South Africans eligible for social benefit in an online-offline environment. That's the cool stuff that's happening outside of the United States. Now, can you bring that type of technology and interest here? Absolutely. But to Bob's point, we're stuck with systems that have been happening in the United States and in Europe for many, many years, and so it's very difficult to disrupt systems here when people are worried about, have different priorities. So in South Africa, these people want to get their digital payment, they want to get their social subsidy, and they want to be able to use it at a grocery store. And here, we're talking, and I would argue that the same people in Baltimore, that's what they want to do too. But when you're working with systems that have legacy technology, legacy regulation, it's very difficult to move the needle in that respect. So I'm actually much more excited about what's happening in Kenya, South Africa, India, Indonesia. It's really great stuff.
Well, we'll try to still import some of that enthusiasm and innovation here with the help of people like Bill.
So I guess I'd make a few points. The vast majority of retail transactions in the United States, the vast majority are cash. It's not even close to anything else. And I don't see that changing. Of course, the problem is cash is disgusting. I mean, if you just actually analyze a dollar bill and what's on it, I mean, it is absolutely disgusting. Now, that having been said, I'm not paranoid about hygiene, but it is disgusting. That having been said, I mean, I hate corruption, but I value access to liberty infinitely more than I value the elimination of corruption. So the elimination of cash is a very dangerous path, very dangerous path. France recently tried to make illegal, I think it was €1,000 transactions. This is a scary, scary thought, okay? I didn't create the playing field for cash. It's been around since all of us were here, and it's going to be around since after we're all gone. I do believe that we're in a new era of money where you can digitize cash. I don't mean an electronic value, a stored value in an account at a bank. I mean the ability to physically store money and carry it with you digitally. That concept didn't exist 20 years ago. So you can now take the basic tenets of cash and make them work in hyper-connected networks. An interesting side effect of this, which is a point Chris was making, is that the government actually gets access to more information this way than they did in the old model of paper cash. A drug dealer would absolutely be insane to start storing money on a blockchain, which is, by the way, why 2 DE agents, in their infinite wisdom, just tried to steal Silk Road money and were caught within days. It wasn't announced for a while, but they were caught very, very quickly. So I would invite people who think about financial inclusion to think about it in terms of not only helping people from a commercial perspective, which is what I've dedicated my work life to, but also from a freedom and liberty perspective. And that's ultimately what commerce does for you, right? Contract law and access to commerce are basically the core tenets of democracy. Without them, it just doesn't work. So I think you're on a very slippery slope if your goal is to just eliminate cash. But you can make cash work for consumers in a way using smartphones and new technology that it doesn't work today.
Great. I think we'll have a couple of questions from the audience. And I will start. Oh, we're fighting over who gets to ask the first question. I think we'll start with Stacy Warden, the director of our Center for Financial Markets.
Okay, great. Chris, could you maybe explain at one level more detail how the Ripple protocol works in the terms of the distributed ledger, and in particular, how do you deal with sort of FX, with the two different systems, and just actually how does it work?
Sure. So distributed ledger systems are they're decentralized systems. So the big thing that's happening here is that value can move without a central operator. So we think that's a big deal, and obviously Bitcoin was the first model to show that that was possible in the world. We think that means you can have basically an internet for value. Right? There's a higher bar for value than there is for information. It doesn't matter if I send an email 100 times, I still communicated. Obviously matters fundamentally if you can send the same piece of value more than once. And until this technology came along, you couldn't do that without a central operator. So it works with a distributed series of servers. Could be anywhere. They're all agreeing on what is the current state of a ledger, or what is the number we all agree on globally. And that means you can take a central operator out of it, which means you can basically have a public infrastructure for value exchange that's basically free, not really owned by anybody. It's sort of a global good, and it's accurate. The people can depend on it. In Ripple is a little different than Bitcoin in that you can put anything of value in it. So we think, we don't believe that the world will adopt a new currency. We think it wants to find a better way to move existing currencies, dollars, euro, RMB, Kenyan shilling, whatever. And that could extend to airline miles or anything you would call value or property. So we think that will be the biggest use case, and that will replace correspondent banking. How is that done? There's kind of a structural change that's happening here in that instead of counting on the top 5 or 6 global money center banks that sort of determine how correspondent banking works today, basically anybody, but more importantly, any liquidity provider, can theoretically be anybody, but we think be dominated by any liquidity provider. Think of foreign currency fund, private equity fund, anybody that has liquidity that they can now basically share in a sort of open liquidity marketplace, and that would enable now banks or non-bank financials, theoretically again any organization, to say I've got $1, I need it to be a euro, and move that in seconds instead of days, and sort of a competitive liquidity marketplace rather than it being sort of dictated by one player that will just sort of route. Okay, that value should go through this path, routing. You could then add that, where this is going, of course, is add all the compliance routing on top of that. And then you got effectively a pretty good Internet of Value system. The world is building this now, I'd say.
Would you still
I
have
think
the same
this is where we're going.
volatility that you've seen, say, with...
So you can pretty much ignore volatility, and if the world is using existing currencies, it's irrelevant to the user, right? I mean, kind of... It's an order book, a giant order book that sort of gets auto-bridged effectively. So you get all the world's order books kind of considered, and then just like you would route packets of information, you're routing value through the cheapest path, and then kind of in the future, you'd sort of add the cheapest path that's the compliant path for whatever sender and whatever receiver. It's effectively what's going on. Is that, I could go on for about 10 hours. So.
Other questions? Yes.
So you lost.
I lost.
She ranks.
So can you take us through a transaction? So tell us, how does money actually get deposited? How is it then transferred? And then talk about this human ATM on the other side. Where are they getting their funds, and how exactly does that work?
Yep. So we had to solve some huge problems if you're trying to basically take what M-Pesa has made work and make it work at a global scale. The first was it's impossible to make this work if there's any central party ever holding anyone else's money. So in the case of Abra, everyone is always holding their own money 100% of the time. So let me walk you through an example. So I, as a consumer, am in Beverly Hills, or let's say East LA is probably a more realistic example, and I want to send money to Mexico. All right. I can find an Abra teller very similar to how I find an Uber driver using the app, the Abra application, which you saw on the screen. Oh, right there, thank you. Exactly, so using that screen. That can be an owner-operated business, it can be an individual consumer, it can be a network of retailers. In the case of large retailers, they have to have money transfer licenses. But in the case of individuals and owner-operated businesses, they're actually holding their own digital currency on their own phone. And those are peer-to-peer transactions. So I find that dot on the screen. I say, oh, I'm going to add $20 to my phone so that I can send it to Mexico. We meet. He presses his teller button, the teller, and he has two buttons on his screen, process deposit and process withdrawal. In this case, the teller would press process deposit, would take a picture of the consumer's screen, which immediately identifies the consumer. It's a very cool process. You don't have to know any technology to do it. And then he types in the amount, and the teller can add a fee, and that is automatically managed by Abra. So if the teller is set up to add a 1% or a $1.50 fee, for example, it would automatically be added. So they'd say, hand me $21.50, for example. The screen for the consumer would automatically show them that. They'd get a push notification that they have to hand over the cash. So now you get a push notification in real time which says you have $20 on your phone. You press the send button, you can now send that money to any phone number in the world. If that consumer doesn't have Abra, they'll get a text message that they need to install Abra to receive the money from your friend in East LA. So you install Abra, you immediately get a push notification to your Android or iPhone that you've now received $20 on your phone. The money is physically on your phone. If you're in Mexico, it's been converted to pesos in real time on the network. Okay? It's not a dissimilar process to the order book that Chris described, with the exception that there's no treasury. There's no concept of treasury. It's all using smart contracts on a Bitcoin blockchain. Okay? Real time. Okay? Now, I, as a consumer in Mexico, see I've got, 250 pesos on my phone, right? So now I do the same inverse function where I bring up the map. I say, oh, I need to get access to my 250 pesos. I find a teller in my village or in town, and I do the reverse transaction. I meet with them. They take a picture of my screen. They say, oh, when you cash out, you're going to get 240 pesos because my fee is 10 pesos. They hand you the 240 pesos. Your phone has pushed the digital currency to their phone, and the withdrawal is done. So 3 transactions: deposit, send, withdrawal, all peer-to-peer. In all 3 cases, everyone was holding their own funds 100% of the time.
Chris, just a quick question. What
Bill.
Legal schema, Bill, sorry. Legal schema are you operating under? Do you carry a money transfer license?
So Abra doesn't touch consumer funds, and Abra is not in the middle of the transaction. So if you shut Abra down, consumers who have these apps will still be able to transact peer-to-peer.
So peer-to-peer,
Yeah, so the master tellers, who are retailers that we've signed up, which we'll be announcing soon, have money transfer licenses because in the cases of deposits, their employees are touching money. It has nothing to do with money transfer because they're not processing money transfer transactions. And in the case of people transacting and sending money back and forth, it's no different than the modern kind of Bitcoin model of people using public and private keys to send money around. Abra is not in the middle of those transactions.
So it's like Uber.
It is Uber for money, that's exactly right.
And it's got nothing to do with financial inclusion. I mean, I want to send money back to the UK and I can send it.
That's right.
It sounds fantastic. It'll kill M-Pesa. But it sounds fantastic. It really does.
I think there's another question here, sir.
I guess I have several questions from sort of the ignorant American perspective. First is, right, how do you get sort of the bottom people in the world to get smartphones? Like, what does it cost? I know what an iPhone costs in America, but what does it cost in Kenya or, India? Or, Second is, it seems rather fee-driven, this whole process. So, what's the cost of, you're saying $1.50 to send $20, right? That's pretty high in terms of fees. That's pretty expensive, right? So then you have sort of, if it's 3 transactions, that's 3 fees on top of just sending $20. So the end user seems like may get $16 from the original $20 that was sent. And then sort of
and just to capitalize, so with most of these, we're talking about a fee-based system that goes directly to particularly, I guess the question is when you have a decentralized network, how is that fee system working where everything's decentralized between all the different actors?
Yeah. I mean, the difference between M-Pesa and what Abra's doing is Abra doesn't set the fees. The teller sets the fees, and we want as much competition in the network as possible. Now, we played with this for months, and the challenge was that, I mentioned when I was in the Philippines, I spent time in villages, I've spent time in the city. The liquidity risk that an Abra teller would be taking in a remote village is much higher than the liquidity risk they would be taking in the city, right? Now, they don't think in terms of return on equity like a lot of you would think about in terms of putting money to work, but that's effectively what the question is. What is my return on equity in my village versus my return on equity in a city? Because the person in the city can rinse and repeat in terms of using the cash over and over again very quickly in the Abra system. The person in the village might be able to do that once or twice a day. So the risk profile in terms of putting the money to work would force a higher cost is the answer to your question. But in a place where there's lots of competition, the price will come down very quickly.
It's also important to understand the scale. So with M-Pesa, which is not going to be dissimilar, you can be paying like 3 cents. So it's a small amount. And to answer the question over the price of smartphones, they're $40 something now and declining.
And then I guess the final question is how broadly, in terms of sort of number of people, are these systems being used?
So in my country, it's out of a population of 40 million, total 43 million. I have 22 million people using M-Pesa, so pretty much all the adults.
But the interesting thing, though, about mobile is that I think globally it's 2% of all transactions right now. It's outsized in places, obviously, like Kenya with M-Pesa and China. But globally, right now, mobile is about, so there's lots of running room with mobile. But I would just sort of say on the mobile space, I think the really cool thing about mobile is if you turn every device into a point of sale, then you're really talking transaction. So if every person can transact on their mobile device, you've really transformed the ecosystem.
And with that note, our session is over. Let's thank this wonderful, wonderful panel. Thank you.
Thank you, and congratulations again.